I appreciate the fact that you've given us a few minutes just to talk you through the summary of the results of 2011 as well as the outlook for 2012. So we have put together a very brief presentation which should not last more than about 5 to 7 minutes, providing this summary for you. We will begin by quickly just summarizing what happened in 2011 for you. In spite of the significant provisions that were taken, I think it's important to highlight that the underlying operating performance of our group was in fact fairly strong. Our net revenues grew by about 35%. Our operating expenses only grew by 4%, so we were able to keep a fairly tight lid on our expenses. Our subsidiaries have actually grown in terms of profitability by about 77% from 2010. And this is one of the reasons why we feel it's important that we hold on to most of our subsidiaries and pursue the holdco model, which I'll be talking about briefly later. Our operating profit before the provisions that we took was actually about 21 billion naira. But unfortunately, because of these provisions, we reported a loss of 9.9 billion naira. The slide before you also showed a summary of the profits and loss. Now, I think briefly looking at the balance sheet of the bank as at December 2011, we'll also see that customer patronage grew as measured by deposits, which grew by 22%. But our loan book declined by 2% because we sold a significant number of our loans to AMCON. However, if we strip out the effect of the sale of the loans to AMCON, our loans actually grew by about 23%. Finally, our acceptances and guarantees, which are off-balance sheet items related mostly to trade finance, actually grew by 49%. So the balance sheet itself showed some resilience and strength during the course of 2011. So in summary, when we look at our ratios, and I'm sorry these slides are a bit busy, but what you'll see is that most of our ratios actually improved, with the exception of maybe return on equity because of the loss, as well as loan growth because of the sale of loans to AMCON. But when we look at other ratios such as liquidity, capital adequacy that is measured by the capital adequacy ratio, as well as interest margins, all those things improved during the course of 2011. If we look at the losses which came about as a result of the provisions that were made, the distribution of those losses, the 15% of those came from impairments to equity underwriting. Now, one of the things that we're doing going forward is that we no longer underwrite equity issues. The second thing was the loan losses coming from the sale of loans to AMCON primarily, where about 75% of our provisions came from. And finally, as many of you are aware, most banks had to reinstate the general loan loss provision, and about 9% of the provisions that we made came from the reinstatement of general loan loss provisions. So this was not actually an operating issue, but really an accounting issue. So I think we can now move on to the highlights of the first quarter of 2012 and what our bank now looks like. And I should stress that these numbers reflect the impact of the merger or the acquisition of FinBank. We have moved from about 130 branches to 278 branches. This 278 branches is a 100% increase from where we were as at December 2011. And this also includes the fact that we have had to close 44 branches that overlap with FCMB. We now have 350 ATMs. We have almost 3,000 point-of-sale terminals now, in line with the whole cashless Lagos initiative. We have about 393,000 debit card users, a total of 1.7 million customers, 27,000 internet banking users, and about 287,000 mobile banking users. What this demonstrates to you is that the bank is steadily moving towards a very diversified retail bank, still retaining its strong wholesale and investment banking platform. In summary, again, when we look at quarter one, most of our ratios continue to improve. Our capital is stronger. We actually have about 83 billion naira of excess capital, more than is required for from the statutory minimum. The ratio that measures your liquidity, which is your loan to deposit ratio, is at 56%, which is actually the lower it is, the better it is. But you don't want it too low because that will suggest that you're not lending enough. But still, this shows that we have a very healthy loan to deposit ratio. And similarly, the actual liquidity ratio itself is about 62%, up from 44%. What these ratios show is that the creditworthiness of the bank is very strong and our ability to meet all obligations continues to strengthen. Finally, our balance sheet footing has increased from 698 billion to about 1.37 trillion naira, 1.037 trillion naira. Move on to the next slide. And if we look at our Q1 results, we have also seen a return to growth, and the recovery is very clear. As at the end of Q1 2012, we reported 55% increase in profit before tax and 98% increase in profit after tax from Q1 of 2011, which suggests that we are very much on the road to recovery and resuming our growth. We will also see that our impairments for loan losses has reduced from last year from 1.2 billion naira in the first quarter to just 146 million naira in the first quarter of 2012. It's important to also note that the Q1 numbers that we have published already include FinBank's results, but it's important to note that FinBank is still running at an operating loss. But once we conclude, once we feel the impact of the closure of the 44 branches, we will now see FinBank contributing to the profitability of the group in 2012 and therefore helping to increase the profitability of the group. Next slide, please. So the outlook for 2012, we can see that the financial outlook is improving significantly. The target date for the legal merger of FCMB and FinBank is now the third quarter of 2012, subject to regulatory approvals from the SEC. We have experienced a few delays because of the ongoing House of Reps questioning of the SEC, which has meant that processes have not moved as fast as we would like. Profitability certainly will be further boosted in subsequent quarters once we feel the impact of the merger. And in the second half of this year, and as a part of the business of this AGM, we will be moving towards a holding company structure. So the last slide really just shares with you broadly what our holding company structure will look like. In essence, you will have the commercial bank, which will include FCMB, our UK subsidiary, and our consumer finance business called Credit Direct. And we will also have the investment banking group, which will include FCMB Capital Markets, CSL Stockbrokers, which also now owns the asset management business. In essence, we believe this structure will create greater simplicity and understanding for shareholders to understand the businesses we're in, but also greater focus for the various businesses that we're in. So the commercial banking will no longer be distracted by the complexity of investment banking, and similarly, investment banking will be focused on maintaining our leadership position in that area. I thank you for your patience in listening.